Hey everyone, Kirk here again at optionalpha.com, where we show you guys how to make smarter trades. And today we're going to go over all the trades that we made for Tuesday, October 28th. So kind of rounding out the month here as we get closer to ending out October. Still lots of earnings trades on the calendar. We didn't have a chance to get into any new trades today. We had a couple off-name earnings trades that we were trying to get into, but just didn't get fills. So it is what it is. You just can't chase the market too much lower or higher for pricing. You just have to sometimes, go with a no trade, and that sometimes is a good trade. So we did have a couple earnings trades that we were able to close out of today, which was really nice, and bank some profits. The first one that we're going to talk about is COH, which is COH. COH had a nice 6% move lower today, so it did open up much lower, but that was inside the one standard deviation move that it usually makes. And so with our strangle that we had the 39.33 call and put on COH. We were able to buy that back literally within 10 minutes of the opening bell for about an 18-cent debit. So a nice $62 profit on that one lot. That's a huge gain for just a one lot trade. And you can see here's a picture of what COH looks like. You can see a nice big move lower after earnings. So it did have a nice little jump after earnings, but that stayed right above where we needed to, which is 33. So it stayed right in that range. And of course, here's the killer for those option premiums, and that is the drop in implied volatility. So again, this just goes to show you, just like I showed the other day in the Take 5 segment on YouTube that we do, it's just 5-minute long videos throughout the day. But this just, again, goes to show you, had you bought that strangle, right, that we had, and assuming a big move in either direction, a lot of people who bought that strangle, right, there was somebody on the other end that bought that strangle because they had to sell it to me. They lost money even though the stock went 6% in one direction, which is a huge one-day move for any stock. And so they lost money purely because of the drop in implied volatility. And we're going to cover this more tonight in the earnings webinar that we're doing, but you can visually see it here on the chart. Twitter was a little bit different. So Twitter, obviously big name stock, is the first time we traded it, and we can tack up a nice little $2 loss to Twitter. But Twitter did actually open towards the lower end of this iron condor. So we had the 54.55 call spread above the market, and then we had the 42.41 put spread below the market. And we decided, because Twitter did open up very close to 42 and actually started to trade below 42 earlier in the day, that we just wanted to make this a scratch trade because, COH was going well. I didn't want to let Twitter, run down. I didn't know if it was going to just continue to fall throughout the day. It did end up rebounding as the whole market kind of rebounded, but you don't know when that's going to happen. And again, we're not playing Twitter for the actual rebound. We were actually playing it for just that one-time move inside of that range and a drop in implied volatility. And we got the drop in implied volatility, but we really didn't see Twitter move inside that range until later on in the day. So we did decide to go ahead and close that out with the $2 loss, basically a scratch on the trade. When we go to the chart here of Twitter, you can see huge drop in implied volatility. That's exactly what we were looking for. And look, every single time that it's had earnings, it's had the same drop in implied volatility. There's nothing new here. Every single time on the chart that it's had earnings, we've had a drop in implied volatility. But Twitter did make a pretty good move lower, which I think some people were a little surprised about, because earnings had been so good the last couple times. It had started to trend higher and move from the upper 30s into 55 territory, and now it has continued to move lower. So it did close the day higher, but it was testing us to the lower end. Just no sense in keeping that trade, in our opinion. Just didn't want to take on the risk. The other trade that we got out of, although it wasn't a one-day earnings trade, this was a trade that we had made over earnings for Halliburton, and that's ticker symbol HAL. And we were able to close this thing out today for a 36-cent debit. We'd actually had this working order for about 3 days now. So we had this working order last Friday, then this Monday, and then today, and we finally got some fills, got all the kind of stars aligned and everything filled in there. One of the techniques that we tried to do was actually split the order up and close out the individual spreads. So that's something you can try as well, but it didn't work for us this time. We actually had more success closing out the whole iron condor by itself. But that's something I did try during that process, just to give you guys a little bit of insight, is splitting up the orders, try closing out the call spread individually, and then closing out the put spread individually, kind of legging out of that iron condor. But again, it didn't work in this case, or else we would have sent out the different alerts for that. We did close out the whole iron condor for a 36-cent debit and banked a nice little profit on a one-lot trade of $58. For Halliburton, again, it was really just a matter of the stock finally seeing some drop in implied volatility, but not moving outside of that range that we initially put it through, which is the 60, 47.5 range after earnings. So we did go through earnings with Halliburton. You can see we definitely got that nice drop in the implied volatility. That's exactly what we wanted. And the stock stayed range bound between 60 and 47.5, which is just below the chart. So it moved up towards our upper boundary, and then it's kind of settled in back neutral here. So I don't want to take the risk of running this thing all the way through expiration to see it run higher or lower, right? Because expiration is so far to the right of our chart here that it doesn't really make sense for another $36. We've made over 50% of our max gain. The smarter trade is to actually close this thing out and bank the profit and move on. Okay, so for adjustments today, we had a couple adjustments. The first one I want to get to is actually Baidu. So Baidu's a little weird, and I don't know if I just missed this, and this may be one of the things I just missed trying to enter trades here, but I swore that Baidu actually had earnings today. And then when I looked at Baidu this morning, it said that it had earnings later today. So I said, maybe I missed earnings. They were later today. And I looked in thinkorswim, and I remember looking in thinkorswim yesterday to make these trades because I don't just arbitrarily pick these tickers. I looked through that calendar in that market watch section of thinkorswim. And now Baidu has earnings tomorrow. Okay, so I don't know if they're pushing earnings and they're just changing their dates, or they haven't been confirmed dates. So right now we're in the middle of a trade that should have been an earnings trade because it's a weekly trade, but now it's turning into kind of a little bit of a position trade because earnings aren't until right now. They're supposedly going to be tomorrow after the open. So here's what we did in Baidu, because it did have a nice little run up today. We wanted to go ahead and add some more premium to the position because implied volatility is staying high. With the run up, it's starting to test our upper boundary on the call side. So what we did is we first added a put side to this trade. We added the 225, the 220, and took in a really nice big credit of 195. So that really means that our credit on Baidu now is much more than the potential that we could lose, right? But that also leaves a very narrow window for us with Baidu earnings. The other thing that we wanted to do is that as Baidu was rolling higher, we wanted to, again, protect ourselves from the downside. So instead of closing out of our original put spread that we had, the 200, 190, or the 205, 200, 195, we went ahead and just bought back the one short put that we had at 200. Okay, so we paid 35 cents to buy that put back. That leaves us long the 195 put. And that to me is basically a lottery ticket and a hedge against possibly really, really bad earnings, right? We saw a lot of stocks like Netflix and for solar, and some of these things are just moving huge lower. Chipotle, some of these big names are just having kind of blowouts where they're moving, a lot lower than everyone expects. So in that case, I decided just, the long option is not really costing us that much right now because it's not worth anything. It's not worth too much, like $10, $15. I decided to keep that long option as kind of a lottery ticket. So when we actually go in here to the Analyze tab of Baidu, excuse me, let me change accounts here, make sure it's in the right account. Okay, so here's the Analyze tab of Baidu, and you can see what we did here today by adding the 225, 220 is we basically recenter the iron condor over where Baidu is trading right now. Okay, so and we may make an adjustment tomorrow or probably just leave this trade on tomorrow, but you can see that Baidu is trading right here in the middle of the screen, and by adding that position below the market, we took into account what Baidu did and basically adjusted this position higher to take in more credit, okay, now that it's testing us to the side. But what you'll also notice is that down below on the chart, we have now just this long option out here. So what this does is this protects us against a big move lower. So if it does make a huge move lower, then we have the opportunity to possibly get out of the trade well before expiration, and maybe even bank a little bit of a profit if it kind of blows up in everybody's faces. I don't necessarily think it's going to happen. I don't really assume that stocks are going to blow up earnings and make a big move lower or higher, whatever the case is. That's why I don't trade those outer ends. But this put option that is down below at 195 isn't really costing us any money. So at this point, it's really acting as a really big safety net in case something really bad happens and Baidu opens up 10 or 15% lower the day of earnings. Okay, so that's the Baidu adjustment that we made. All right, so the last adjustment that we made it's kind of a series of adjustments, and that's all on X. So a lot of you who are still following the X trade that we've had, we have now rolled everything, and basically what I said in the trade remarks when I sent out the alert was that we've rolled everything from November to December. Now, how you actually do that is you sell a calendar spread. So that's actually logistically how you set up a trade to move a short option from one month to the next month. So in this case, the calendar, because you sell the front month and buy the back month, we're going ahead and we're selling a calendar. So we're going to reverse that, and we're going to buy the front month back, which is the November. So in all these cases, we bought the November options that we were short, and then we entered new December options at the exact same strike price. Now you'll notice in all of these cases, because we were trading the further out contract month now, we took in additional credit. So all of these options, we're continuing to take in all these credits and extend our trading duration. So we extended it all the way out to December. The only options we didn't have a chance to roll today, just because we didn't get filled, were the 44 puts. So we do still have the 44 puts, which we have for November, and obviously we're going to hold them through earnings this evening and see what happens, and then roll them to December tomorrow, hopefully, or maybe close them out if they're profitable, or I don't know what's going to happen with earnings, but we'll manage those puts so that they're out with December options with everything else. But the reason that I did this, and I mentioned this in the trade remarks as well, is that X still has very high implied volatility and is going to go through earnings this evening. So what I wanted to do is take advantage of this high implied volatility now, because this high implied volatility is not only affecting the November options, but it's also affecting the December and January and all those other options that are out there. So if we can take advantage of this high implied volatility, even through this earnings event where we know that implied volatility is going to drop, then that might give us a little bit more premium in our piggy bank to hold on to this position for another month or so and continue to see if it can manage a profit. If we look at the actual Analyze tab here of X, you'll see that now with the new adjustments that we made, we still need the stock to maybe move just a little bit lower. We don't have the 44 puts in here yet, but you can see that if we actually hold this position and if the stock kind of moves somewhere between 33 and 37, we actually could make about $3,000 or $4,000 back on this trade, okay, which would get us very, very close to overall break even on all of the trades that we've made. So this whole idea of extending timeline and extending the trading duration and keep taking in a credit has been working very, very well. And we're going to continue to hold this position because it is a big position for us. We definitely want to, use this as a case study in the future of why you should, hold on to some of these positions and really let the market work for you, right? It just takes time. It takes patience. It's hard to hold positions like this, but you have to make adjustments along the way to keep adding credit and keep extending the trading timeline until you're able to really, really kind of whittle down that loss or potentially make a profit back. So that's what we're doing in X. We'll see what happens tonight with the earnings. We don't know what's going to happen tonight with earnings, so it'll be a nice little surprise for us tomorrow, and we'll see where it ends up. As always, hope you guys enjoy these videos. If you have any comments or questions, please add them right below. I'll be happy to get back to all of those tonight or tomorrow before the open. And if you're watching this on YouTube, and I don't say it enough, but you're actually getting this video, if you're watching it publicly on YouTube, about 15 days after we make these trades. So what that means is that you're behind the 8 ball and you're getting these alerts well after we've been in or out of securities. Sometimes we're in and out of multiple securities before you actually see the first video publicly on YouTube. And that's because they're all protected for our members inside OptionAlpha.com. So if you want to get these alerts and this video every night, you got to sign up for a trial at OptionAlpha.com. Until then, happy trading.